Picture this. It's 2017 in Beijing, and a new coffee shop just opened near your office. The place looks sleek, modern, and the coffee costs less than half what you'd pay at Starbucks. You download their app, and suddenly you're getting buy one get one free deals, discounts on every order, and free delivery straight to your desk. Sounds pretty good, right? Well, this wasn't just happening at one shop. This was happening at thousands of locations across China, almost overnight. Welcome to the wild story of Luckin Coffee, the company that promised to revolutionize China's coffee market and ended up pulling off one of the biggest financial frauds in recent history. Now, before we dive into how they faked $300 million in sales, let's talk about why anyone believed in Luckin Coffee in the first place. Because here's the thing. Their story wasn't just believable, it was intoxicating. China, the land of tea drinkers, was experiencing a coffee revolution. The middle class was exploding. Young professionals wanted their caffeine fix, and Starbucks was charging premium prices that many felt were too expensive for daily consumption. The market was ripe for disruption, and investors knew it. They were practically salivating at the opportunity to find the next big winner in this massive, growing market. Enter Luckin Coffee, founded in June 2017 by Jenny Qianjia and Charles Zhengyao Lu. Charles, by the way, wasn't some coffee enthusiast or hospitality expert. He was a serial entrepreneur who had previously founded UCar, a ride-sharing company that went head-to-head with Didi Chuxing in China. This guy knew how to burn cash to gain market share, and he knew how to tell a compelling growth story to investors. Jenny, his co-founder and the public face of Luckin, brought operational expertise and a vision for how technology could transform the traditional coffee shop model. Together, they crafted a narrative that venture capitalists and institutional investors couldn't resist. We're going to out-tech and outscale Starbucks in the world's largest market. Their pitch was simple but powerful. Starbucks, they argued, was old school. You had to walk into a store, wait in line, pay high prices, and the whole experience was built around the idea of the coffee house as a third place between home and work. Luckin would flip this model on its head. They would be mobile first, app only, with smaller pickup locations and a heavy focus on delivery. No need for expensive real estate in prime locations. No need for cozy seating areas that take up valuable space. Just efficient, tech-driven coffee distribution that could scale rapidly and cheaply. They even had a catchy slogan in Chinese that translated roughly to, "This cup, who doesn't love it?" The marketing was everywhere, featuring celebrity endorsements and aggressive digital campaigns targeting young professionals. And scale they did. By January 2018, just 7 months after launching, Luckin had opened 500 stores. By the end of that year, they had over 2,000 locations across China. To put this in perspective, it took Starbucks nearly 20 years to reach the same number of stores in China. Luckin did it in 18 months. The speed was absolutely breathtaking, and it wasn't just about opening stores. They were acquiring customers at an unprecedented rate through massive discounts and promotional campaigns. Every new user got free coffee, existing users got credits for referring friends, and the app gamified the entire experience with challenges and rewards. It was like a coffee-fueled version of a social media platform, and people were hooked. Investors started throwing money at Luckin like it was going out of style. In July 2018, they raised $200 million in a Series A funding round, led by Singapore's GIC and China International Capital Corporation. By December, they closed a Series B round that brought in another $200 million. The valuation kept climbing, reaching over $2 billion before the company even turned 2 years old. Wall Street analysts were calling it the future of retail, a perfect example of how China's tech-savvy consumers were leapfrogging traditional business models. The Financial Times, Bloomberg, CNBC, Everyone was covering Luckin as the next big thing in Chinese tech and retail. But here's where things get really interesting. In May 2019, just 23 months after opening its first store, Luckin Coffee went public on the Nasdaq stock exchange. Think about that for a second. A coffee chain that wasn't even 2 years old, that had never posted a profit, that was burning through hundreds of millions of dollars, managed to convince American investors to buy into its IPO at $17 per share. The company raised $650 million in that offering, and the stock immediately jumped on its first day of trading. Institutional investors from around the world were loading up on Luckin shares, convinced they were getting in early on China's answer to Starbucks. The numbers Luckin was reporting seemed to support all this enthusiasm. Revenue was skyrocketing quarter after quarter. Customer counts were exploding. The company claimed to have processed over 90 million transactions in 2019 alone. They were opening an average of 8 new stores every single day. Store-level operating margins were improving. The narrative was clear. Yes, we're losing money now because we're investing heavily in growth, but once we achieve scale and reduce our promotional spending, the profitability will follow. It's the classic tech startup playbook. Growth first, profits later. And investors had seen this story play out successfully with companies like Amazon, Uber, and countless Chinese tech giants. Why wouldn't it work with coffee? By January 2020, Luckin stock had surged to over $50 per share, giving the company a market capitalization of roughly $12 billion. $12 billion. For a company that had existed for less than 3 years and had never made a profit, the founders and early investors were becoming billionaires on paper. Charles Liu's stake alone was worth over $2 billion. Financial media was celebrating Luckin as proof that China could produce world-class consumer brands that competed on innovation and execution, not just on cost. The company announced plans to open another 2,500 stores in 2020, bringing their total to over 6,000 locations. They were even starting to expand into other products like tea drinks and light snacks, positioning themselves as a broader lifestyle brand. But you know what they say about things that seem too good to be true. While investors and the media were celebrating Luckin's meteoric rise, something didn't smell quite right with these numbers. A few skeptical analysts and short sellers were starting to ask uncomfortable questions. How could a company grow this fast and improve margins simultaneously? Why were the customer acquisition costs so low compared to other Chinese tech companies? Where exactly was all this transaction volume coming from? And most importantly, if you actually visited these Luckin stores, did the crowds match the sales figures the company was reporting? Spoiler alert, they didn't. Not even close. But we're getting ahead of ourselves. Right now, in early 2020, Luckin Coffee is still riding high, still adding stores, still reporting explosive growth, and still convincing investors that they're witnessing the birth of a global coffee empire. The stock is soaring. The founders are wealthy beyond imagination. And Wall Street analysts are falling over themselves to issue bullish reports on the company's prospects. Everything looks perfect from the outside. The rocket that rose too fast is still climbing. And nobody, at least nobody who mattered, is asking whether this rocket might actually be built on a foundation of lies. So how does a company go from $12 billion darling to exposed fraud in a matter of months? How do you fake $300 million in sales? And more importantly, for you as an investor, or just someone interested in how financial markets work, how did supposedly smart institutional investors, auditors, and regulators miss this fraud until it was too late? Well, get comfortable, because we're about to pull back the curtain on one of the most brazen corporate frauds of the 21st century. And trust me, the details are going to blow your mind. All right, so now you're probably wondering, what exactly was Luckin's business model? How are they planning to make money while giving away so much free coffee and burning through cash like it was confetti at a parade? Well, let's break down the mechanics of their operation. because understanding how they claimed it would work is crucial to understanding how they ultimately pulled off the fraud. And honestly, on paper, their model wasn't completely insane. It was aggressive, sure, but it had a certain logic that made investors believe this could actually work. First, let's talk about the core strategy. Technology-driven efficiency. Luckin positioned itself as a tech company that happened to sell coffee, not a coffee company that used some tech. This distinction mattered enormously to investors, because tech companies get valued on revenue multiples that are way higher than traditional retail. Think about it. Starbucks trades at maybe 2 to 3 times revenue, while a hot tech company might trade at 10 or 15 times revenue. By framing themselves as a tech disruptor, Luckin was essentially asking for a premium valuation from day one. Their app wasn't just a way to order coffee, it was supposedly a data goldmine that would allow them to understand customer preferences, optimize inventory, predict demand, and eventually cross-sell other products. The physical footprint strategy was clever too, at least in theory. Instead of building massive, comfortable Starbucks-style cafes with expensive rent in premium locations, Luckin focused on 3 types of stores: pickup stores, relax stores, and delivery kitchens. Pickup stores were tiny, maybe 20 to 30 square meters, located in office buildings or high-traffic areas where people could grab their pre-ordered coffee and go. Relax stores were slightly bigger and had some seating, but nothing like a traditional cafe. Delivery kitchens were basically just production facilities with no customer-facing area at all, purely designed to fulfill app orders and deliveries. This approach meant lower rent costs, faster store openings, and theoretically better unit economics once they reached scale. Now here's where the growth flywheel comes in, and this is what really got investors excited. Luckin's plan was to acquire customers aggressively using heavy subsidies and promotions, get them hooked on the convenience and quality of the product, then gradually reduce the discounts as customer habits formed. It's the classic loss leader strategy that companies like Uber, DoorDash, and countless Chinese tech firms had used successfully. You lose money acquiring each customer initially, but if the lifetime value of that customer exceeds the acquisition cost, you win in the long run. Luckin claimed that their customer acquisition cost was around $15 to $20 per user, and they argued that each customer would generate far more than that in lifetime value through repeated purchases. The numbers they were throwing around seemed to support this thesis. In their IPO prospectus and quarterly earnings reports, Luckin claimed that monthly transacting customers grew from 1.3 million in the fourth quarter of 2018 to over 9 million by the end of 2019. Average monthly purchases per customer were increasing. The average selling price per item, while lower than Starbucks due to promotions, was still supposedly profitable at the product level once you removed the corporate overhead and growth investments. Store-level contribution margins, basically revenue minus direct store costs, were reportedly improving quarter over quarter, moving from negative territory toward break-even and eventually positive margins. Let's dig into the unit economics they were claiming, because this is important. Luckin said that a typical pickup store could generate around 300,000 to 400,000 yuan in annual revenue, which is roughly $45,000 to $60,000. Operating costs for these small stores were supposedly much lower than traditional cafes. Minimal rent, fewer employees because everything was app-based, and efficient inventory management thanks to their tech platform. They claimed that established stores, those open for more than 12 months, were approaching or achieving store-level profitability. If true, this would mean that once they stopped the heavy promotional spending and their store base matured, the entire company could flip to profitability relatively quickly. The product strategy seemed sound too. Luckin wasn't trying to compete with Starbucks on the premium coffeehouse experience. They were going after the mass market of Chinese consumers who wanted good, convenient, affordable coffee for daily consumption. Their menu was simpler than Starbucks, focusing on core drinks like lattes, Americanos, and cappuccinos, with some localized options like cheese tea and fruit-based beverages. The coffee itself was reportedly decent quality. They partnered with suppliers and used automatic espresso machines that ensured consistency across locations. The idea was that Chinese consumers, especially younger ones, didn't need the ambiance of a traditional cafe. They just wanted their caffeine fix delivered quickly and cheaply. And then there was the data play. Luckin's management loved talking about data. Every transaction went through the app, which meant they could track everything. What customers ordered, when they ordered, where they ordered from, what promotions worked best, and how to optimize the entire supply chain. They claimed this data advantage would allow them to run circles around competitors. Want to know which stores to open next? The data will tell you. Want to optimize your menu for maximum profitability? The data will tell you. Want to personalize promotions to maximize customer lifetime value? You guessed it, the data will tell you. This narrative fit perfectly into the broader investor obsession with big data and artificial intelligence in the late 2010s. The growth trajectory they were projecting was equally ambitious. Management's plan was to have 10,000 stores by the end of 2021, which would make them larger than Starbucks in China in just 4 years of operation. They argued that China's coffee consumption per capita was still tiny compared to developed markets. Only about 6 cups per person per year versus several hundred in countries like the United States or South Korea. If they could capture even a small share of this massive, underpenetrated market as it grew, the revenue potential was enormous. We're talking about potentially tens of billions of dollars in annual revenue within 5 to 7 years. Investors were also attracted to the capital efficiency story. Unlike traditional retail expansion that requires massive upfront investment in each location, Luckin's model supposedly required relatively little capital per store. The pickup locations were cheap to build out. The equipment was standardized and relatively inexpensive, and the payback period was claimed to be just 6 to 9 months. This meant that the company could theoretically scale rapidly without requiring endless rounds of dilutive equity financing. Once they achieved a certain scale and reduced promotional spending, they could potentially fund expansion from operating cash flow. That's the holy grail for investors. A company that reaches escape velocity and becomes self-sustaining. The competitive moat they were building seemed real too. By the time competitors realized how fast Luckin was growing, they'd already have thousands of stores, millions of loyal customers, and enough data and operational efficiency to maintain their lead. This is called a first-mover advantage, and in winner-take-most markets like Chinese tech, being first with massive scale can create a nearly insurmountable advantage. Starbucks, for all its brand power, couldn't move as fast because it was tied to its traditional store model. Local Chinese competitors didn't have access to the same level of venture capital funding. Luckin seemed to be in a perfect position. So you can see why investors believed, right? This wasn't some obviously stupid business model. It was actually a pretty sophisticated strategy that combined elements of tech-driven disruption, retail efficiency, and aggressive growth tactics that had worked for other companies. The management team talked a good game. The numbers seemed to back up their claims, and the market opportunity was undeniably massive. Plus, they had big-name investors and auditors providing credibility. Ernst & Young was their auditor, for crying out loud, one of the Big Four accounting firms. If EY signed off on the numbers, surely they must be legit, right? But here's the thing about business models that seem too good to be true. Sometimes they are. And Luckin's model had a fatal flaw that investors either didn't see or chose to ignore. The entire strategy depended on the numbers being real. The customer counts had to be real. The transaction volumes had to be real. The improving unit economics had to be real. Because if any of those core metrics were fabricated, the whole beautiful story collapsed like a house of cards in a windstorm. And as we're about to discover, a lot of those numbers weren't just slightly optimistic or based on aggressive accounting. They were completely made up, but we'll get to that. For now, just remember, This is how Luckin convinced some of the smartest investors in the world to give them billions of dollars. The story was compelling, the opportunity seemed real, and the numbers appeared to confirm everything management was saying. Until they didn't. Up to this point, everything in the Luckin story looks like a dream, right? Hypergrowth, flashy presentations, the country of Uncle Sam rolling out the red carpet on Nasdaq, and investors patting themselves on the back for finding the next big thing. But let me ask you something. Have you ever looked at a company and thought, this is growing a bit too perfectly? That feeling that something is off, even if on paper the numbers look flawless, is exactly where the cracks in Luckin's story begin. You have to remember that financial markets are not full of naive people throwing darts at a board, or at least not all the time. There is a group of players called short sellers whose entire job is to bet against companies they think are overvalued or directly fraudulent. A short seller makes money when a stock goes down, not up, so they have every incentive to dig into the ugly details that everyone else prefers to ignore. Now I know what you might be thinking. Are these people the villains of the story? And the funny thing is that in scandals like Luckin, the supposed villains end up looking a lot like the whistleblowers. So what started to bother the skeptics about Luckin Coffee? On the surface, the company was reporting insane growth in sales and customer numbers quarter after quarter. But if you zoomed in a bit, some of the metrics started to behave in ways that did not quite fit with reality. Same-store sales growth was incredibly strong despite massive expansion, which is already a bit suspicious. Normally, when a company opens thousands of new locations very fast, existing stores cannibalize each other, and growth per store tends to slow down. In Luckin's case, both the total number of stores and the average sales per store were apparently shooting up at the same time. Another weird detail was the level of discounting. Luckin was showering customers with coupons, free drinks, and promotions, essentially training people to never pay full price. Now, that by itself is not fraud. It is just a super aggressive customer acquisition strategy. But here is the catch. If you are giving away so much coffee, your reported revenue growth should reflect a heavy impact from discounts. Yet Luckin's reported net revenue per cup looked surprisingly healthy, as if all these giveaways were somehow not hurting their top line as much as you would expect. That is the type of thing that makes a forensic accountant raise an eyebrow and start sharpening the pencil. Then you had the on-the-ground reality versus the official story. Analysts, bloggers, and individual investors started visiting Luckin stores and quietly counting customers. This sounds super low-tech, but it is one of the most powerful tools you have as an investor. Just go and look. Some stores were full at peak hours, sure, especially in major business districts, but many others looked fairly quiet much of the day. Nothing like the frenzy you would expect from a company claiming to be processing tens of millions of orders. And if you have ever tried to get a seat in a Starbucks in a big city at rush hour, you know what real demand looks like. Here is where the short sellers come in big time. A well-known short-selling firm started to receive anonymous tips suggesting that Luckin's numbers were not just inflated, but systematically faked. Imagine someone telling you, hey, this super hot stock everyone loves is actually cooking the books. What would you do? They decided not to take it at face value, and instead launched a massive, almost obsessive investigation into what was really happening inside those blue and white coffee shops. To grasp the scale of what they did, you have to picture this. They hired dozens and dozens of people across multiple cities in China and gave them a simple but tedious mission. Sit near Luckin stores, record how many coffees are actually being sold, and collect as many receipts as possible. We are talking thousands of hours of surveillance and tens of thousands of physical receipts. No fancy Wall Street model, no secret algorithm, just raw, old-school fieldwork. And why focus on receipts? Because a receipt is a tiny contract between reality and the accounting system. If you can compare the sum of real receipts with what the company claims, you can see if the story holds up. Meanwhile, on the surface, Luckin kept playing the role of Chinese tech darling. Management kept doing upbeat conference calls, proudly announcing record revenues and expanding margins. The tone was always the same. We are executing our strategy flawlessly. The data proves we are winning. And this is just the beginning. And to be fair, if you only listened to the official communication, you would probably feel reassured. Everything sounded professional, polished, and under control. This is one of the dangers of being an investor. If you only listen to what management wants you to hear, you can end up living in a parallel universe. But as the independent investigation progressed, a different universe was taking shape. Those teams counting customers and scanning receipts were starting to see a pattern that did not match the fairy tale. Store traffic levels, average ticket sizes, and the number of paid transactions did not align with the astronomical revenue growth reported in Luckin's financial statements. In plain English, the real world was not backing up the official numbers. And when reality and accounting diverge too much, you can bet something nasty is hiding in between. Now, I do not want to bog you down in every technical detail here, okay? But there is one key concept you need to understand called channel checking. Channel checking is when analysts and investors look at what is happening in the actual distribution channels of a business, stores, websites, delivery platforms, to verify if the sales figures make sense. It is like cross-examining a witness. The company says one thing, the channel says another. In Luckin's case, the channel checks were screaming that the numbers were off, and not by a tiny margin. At the same time, some people started scrutinizing Luckin's cost structure. For example, the reported expenses for raw materials, like coffee beans, milk, and cups, did not seem to match the volume of drinks the company claimed to be selling. If you say you sold 10 million cups, you should have bought a certain amount of inputs. If your reported procurement is way below that, something is fishy. It is a bit like your friend telling you they go to the gym 6 days a week, but somehow their sneakers are always brand new. At some point, the story and the evidence have to match, or you start doubting. There were also questions around related party transactions. This is a fancy way of saying deals with companies that are connected to insiders, like executives or major shareholders. These related party dealings are not illegal by default, but they are a classic red flag in corporate frauds because they can be used to move money around. Or fake revenue. Some filings suggested that Luckin was doing business with companies that had ties to its leadership, raising the possibility that part of the revenue was being artificially generated through friendly counterparties. All of this culminated in a bombshell, a long, detailed report accusing Luckin Coffee of fabricating a huge portion of its sales. The report claimed that, based on extensive on-the-ground research, Luckin had exaggerated its revenues by a massive margin during certain quarters. It walked through the methodology, the receipt collection, the customer counts, and the discrepancies between real-world activity and reported financials. And here is the part where you come in as an investor. When you see a document like that, what do? Do you panic and sell everything? Or do you say, this is just a hit job from people who want the stock to crash? The market, at first, was divided. Some investors dismissed the report as just another attack from short sellers trying to profit from fear. The company itself, of course, denied everything and called the allegations misleading and false. They insisted that their accounting was solid, their growth was genuine, and their auditor had validated the numbers. A lot of people wanted to believe them, because accepting the possibility of fraud would mean admitting that they had been fooled. And trust me, nobody on Wall Street likes to look stupid, especially in front of their clients. But others took the report seriously and started questioning their assumptions. Analysts who had been blindly positive on the stock now had to respond to clients asking very uncomfortable questions. Portfolio managers who held big positions in Luckin suddenly had to consider the risk that this shiny growth story might actually be a ticking time bomb. Some decided to quietly reduce their exposure without making too much noise. Others doubled down, convinced that the short sellers were exaggerating and that the truth would vindicate the company. This is one of those moments where you see how psychology and incentives drive markets. On one side, you had people whose performance and reputation were tied to Luckin's success, and who therefore had every incentive to downplay the accusations. On the other, you had short sellers who made money if the stock collapsed, so obviously they were motivated to highlight every possible red flag. And in the middle, you had regular investors like you, trying to figure out who to believe. It is messy, it is emotional, and it is exactly in that chaos where big fortunes are made and lost. The key point of this chapter, and what I want you to take away, is that the cracks in the Luckin story were visible before the official confession. Slowing down, comparing what the company said with what the real world showed, and listening to uncomfortable voices could have saved a lot of people a lot of money. But humans, especially in bull markets, love a good growth story. When everything is going up, it is painfully easy to ignore the little warning lights blinking on the dashboard. In the next step of this story, those warning lights stop being subtle. They start blaring like a siren. Because as you are about to see, Luckin was not just massaging its numbers a little bit. The $300 million in fake sales were not a rounding error or an overly optimistic forecast. They were the core of the entire narrative. And when the truth finally came out, it did not just expose a flawed business model, it revealed a deliberate systematic fraud that shook investor confidence in an entire market. All right, here we go. This is the moment where the entire Luckin story explodes, where the perfect facade shatters and reveals what was actually happening behind the scenes. And I have to tell you, when the details of this fraud became public, even people who had seen corporate scandals before were shocked by the sheer audacity and scale of what Luckin had pulled off. We are talking about a company that fabricated approximately $300 million in sales. And they did it in a way that was both incredibly simple and disturbingly systematic. So how exactly do you fake $300 million in revenue? It is not like you can just type bigger numbers into a spreadsheet and hope nobody notices, right? Well, actually, that is kind of what they did, but with a lot more steps and a whole network of people involved in covering it up. The fraud at Luckin was not the work of one rogue accountant cooking the books late at night. This was a coordinated effort that involved executives, store managers, employees, and even third-party companies that existed solely to help create the illusion of sales that never actually happened. Let me break down the mechanics for you, because understanding how they did it is crucial to understanding how frauds like this can go undetected for so long. The core of the scheme was fabricating transactions. Luckin would create fake orders in their system, orders that looked legitimate in the database, but that never involved real customers buying real coffee. These phantom transactions would then show up in the company's revenue numbers, making it appear like business was booming when in reality, those sales never existed. It is like claiming you sold 1,000 sandwiches when you only sold 200, but making sure your cash register and inventory records somehow support the lie. But here is where it gets tricky. You cannot just invent revenue without also fabricating the entire paper trail that goes with it. If you claim you sold coffee, you need to show that you bought the coffee beans, the cups, the milk, and all the other supplies required to make those drinks. Otherwise, any half-decent auditor would immediately spot the discrepancy. So Luckin did not just fake sales, they also faked their costs and expenses to make the numbers internally consistent. They inflated their reported purchases of raw materials and supplies, creating invoices and payment records for goods that were either never bought or bought in much smaller quantities than claimed. To pull this off, Luckin worked with related parties and shell companies. These were businesses that appeared independent but were actually controlled by or closely connected to Luckin insiders. The company would place fake orders with these entities. The entities would send fake invoices, and money would flow back and forth to create the appearance of legitimate business activity. In some cases, the funds would eventually circle back to people connected with Luckin, creating a closed loop where the same money was just moving around to support the illusion. It is financial theater, a performance designed to fool auditors, investors, and regulators. Now let me give you a concrete example of how this worked on the ground, because the devil is always in the details. Store managers and regional supervisors were given sales targets that were essentially impossible to hit through legitimate means. When they could not meet these targets, they were instructed or pressured to create fake transactions. This could mean entering orders into the system that never happened, recording sales during hours when the store was actually closed, or inflating the number of items per transaction. Some employees would use the Luckin app to place fake orders themselves, creating a digital trail that looked real in the database, even though no coffee was ever made or delivered. The scale of this operation was mind-blowing. We are not talking about a few $1,000s here and there to smooth out a bad quarter. During the second, third, and fourth quarters of 2019 alone, Luckin fabricated around $310 million in revenue. To put that in perspective, that represents roughly 40% of the company's total reported sales during that period. Nearly half of their supposed business was completely imaginary. And remember, this was a publicly traded company on the Nasdaq, filing quarterly reports with the Securities and Exchange Commission, being covered by major Wall Street analysts, and trusted by institutional investors around the world. So how did they think they would get away with this? Part of the answer is that they were betting on continued growth and access to capital. As long as they could keep raising money and expanding, they could use new investor funds to cover the gaps created by the fake revenue. It is a classic Ponzi-like dynamic. You use money from new investors to pay old investors and keep the machine running, all while hoping that eventually the real business catches up to the fake numbers. The plan, if you can even call it that, was probably to fabricate their way to a scale where the company could become legitimately profitable and then quietly phase out the fraud. But there is a massive problem with that strategy. It requires everything to go perfectly. You need investor appetite to stay strong. You need your stock price to keep rising so you can issue more shares at high valuations. And you need regulators and auditors to never dig too deep. The moment any of those pieces fails, the whole scheme unravels. And in early 2020, multiple pieces started failing at the same time. The short seller report had already raised serious questions. Institutional investors were getting nervous. And then something happened that nobody could have predicted. An internal whistleblower decided to come forward. In late January 2020, Luckin's board of directors received an anonymous report from someone inside the company. This was not an outsider making accusations. This was an insider with direct knowledge of the fraud, providing detailed information about how the fabrication scheme worked. The report allegedly included specifics about which executives were involved, how the fake transactions were being generated, and the approximate scale of the fabricated revenue. For the board, this was a nuclear bomb landing on their desk. They could no longer dismiss the accusations as the work of hostile short sellers or disgruntled competitors. This was coming from inside the house. The board had no choice but to launch an internal investigation, and they brought in a special committee to look into the allegations. Now, here is the thing about internal investigations at companies accused of fraud. They are awkward as hell. You are essentially asking a company to investigate itself, which creates all kinds of conflicts of interest. But in this case, the special committee did bring in external forensic accountants and lawyers to review the evidence. And what they found was damning. The investigation confirmed that a significant portion of Luckin's reported sales were indeed fabricated, involving COO Jian Liu and other employees who reported to him. The comparison between real receipts and reported sales became the smoking gun. Remember those teams hired by short sellers who sat outside stores and collected receipts? Well, the internal investigators essentially did the same thing, but with access to Luckin's internal systems. They could compare what the database said was sold with physical evidence of actual transactions. They could look at inventory records, supplier invoices, and bank statements to see if the money flows matched the claimed sales. And across the board, the numbers did not add up. The real activity was dramatically lower than the reported figures, and the gap was too large and too systematic to be explained by accounting errors or differences in methodology. One of the particularly brazen aspects of the fraud was how they handled the discrepancy in physical inventory. If you are claiming to sell millions of cups of coffee, you need to account for the cups, the coffee beans, the sugar packets, everything. Luckin dealt with this by also fabricating their cost of goods sold, making it appear that they had purchased and used far more supplies than they actually had. But even this had limits. At some point, the sheer volume of claimed sales would require inventory movements that would be visible to suppliers, logistics companies, and auditors. The fact that they managed to sustain this fiction for multiple quarters speaks to either the incompetence of the auditors or the sophistication of the cover-up, and probably both. By early April 2020, the company could no longer keep the secret. On April 2nd, Luckin issued a stunning announcement. They had discovered fabricated sales transactions totaling approximately 2.2 billion yuan, which is around $310 million. They disclosed that the COO and several employees reporting to him had engaged in misconduct, and that the board had suspended the COO and was conducting a full investigation. The announcement was carefully worded, trying to frame this as the actions of a few bad actors rather than a systemic failure, but investors were not buying it. The stock, which had been trading around $26 per share, immediately collapsed. Think about what this means for a second. If you were an investor who bought Luckin shares near the peak, you had just learned that nearly half the company's revenue was fictional. Your investment thesis, that you were buying into a hyper-growth company disrupting the Chinese coffee market, had just been revealed as partly based on lies. The growth was not as strong as you thought, the unit economics were not as good as claimed, and the management team had been systematically deceiving you. It is the kind of revelation that makes you question everything you thought you knew about the company, and frankly, about your own judgment. The $300 million lie was not just a number on a financial statement. It represented a betrayal of trust on a massive scale. Retail investors who believed in the China growth story lost their savings. Institutional investors who did months of due diligence looked like fools. Employees who had worked hard to build a real business were tainted by association with fraud. And the entire Chinese tech sector took a reputational hit, as investors started wondering how many other companies might be playing similar games with their numbers. The consequences of this lie were about to ripple far beyond Luckin's headquarters. And as you are about to see in the next chapter, the fallout was swift, brutal, and absolutely devastating. When Luckin Coffee announced on April 2, 2020, that they had fabricated $310 million in sales, the reaction was immediate and catastrophic. The stock, which had closed at $26.20 on April 1st, opened the next trading day at $4.39. That is a decline of roughly 83% in a matter of hours. If you had $10,000 invested in Luckin shares the day before the announcement, you woke up with less than $2,000 left. And honestly, even that was generous, because the carnage was far from over. Trading in Luckin stock was halted multiple times that day due to extreme volatility. The circuit breakers kept kicking in as panicked investors rushed to dump their shares. Every time trading resumed, the stock would plunge further as more people tried to exit. It was a financial bloodbath, the kind of collapse that makes headlines around the world and becomes a cautionary tale taught in business schools for decades. And here is the worst part. Even at $4, the stock was probably still overvalued, because nobody knew how much of the company's business was actually real. The Securities and Exchange Commission immediately launched an investigation. When a foreign company listed on a U.S. exchange commits fraud, the SEC takes it very seriously because it undermines confidence in American capital markets. They started gathering evidence, interviewing witnesses, and working with Chinese authorities to understand the full extent of the misconduct. The The Department of Justice also got involved because securities fraud is not just a civil matter. It is a federal crime that can result in prison time for the people responsible. The walls were closing in fast on Luckin's leadership. Lawsuits started flying from every direction. Class action attorneys, smelling blood in the water, filed multiple lawsuits on behalf of investors who had been defrauded. These lawsuits named the company, the executives, the board members, and even the auditor Ernst & Young, arguing that EY should have detected the fraud during their audits. And you know what? They had a point. How does a Big Four accounting firm miss fabricated sales amounting to 40% of revenue? Either the fraud was incredibly sophisticated, or the auditors were not doing their job properly, and neither answer is reassuring. The banks that had underwritten Luckin's IPO also found themselves in hot water. Credit Suisse, Morgan Stanley, and other prestigious investment banks had helped Luckin raise hundreds of millions of dollars from investors. And now those investors wanted to know what due diligence the banks had actually performed. Did they verify the sales figures? Did they visit enough stores? Did they question the aggressive growth projections? The banks, of course, defended themselves by saying they relied on the company's representations and the audited financials. But that defense only goes so far when you are collecting millions in fees to bring a company public. Meanwhile, back in China, the fallout was equally severe. The China Securities Regulatory Commission launched its own investigation into Luckin and demanded explanations from the company's leadership. Chinese authorities were furious because the scandal made Chinese companies look unreliable and potentially scared away foreign investment. Remember, China had been working hard to attract international capital and position its tech sector as world-class. Having a company like Luckin exposed as fraudulent set back those efforts significantly and reinforced negative stereotypes about Chinese corporate governance. COO Jian Liu, who had been identified as the mastermind behind the fabrication scheme, was terminated along with the chief operating officer and several other employees. But termination was just the beginning of their problems. Chinese authorities opened criminal investigations, and Liu eventually faced charges of fabricating transactions and falsifying financial reports. The legal consequences were mounting, and it became clear that this was not going to be one of those situations where executives walk away with a slap on the wrist and a golden parachute. Founder and chairman Charles Liu also came under intense scrutiny. While he was not directly implicated in the day-to-day fabrication of sales, he was the largest shareholder and the public face of the company. Investors wanted to know, did he know about the fraud, or was he asleep at the wheel? Either way, his reputation was destroyed. The billionaire status he had enjoyed just weeks earlier evaporated as his stake in Luckin became essentially worthless. He stepped down from the board in July 2020, marking the end of his involvement with the company he had founded just 3 years earlier. In May 2020, just a month after the fraud disclosure, Nasdaq delisted Luckin Coffee. Delisting means the stock can no longer trade on the exchange, which is basically the financial equivalent of being kicked out of the club. For a company that had celebrated its Nasdaq debut with so much fanfare just 12 months earlier, the delisting was a humiliating finale. Luckin's shares were relegated to the over-the-counter market, where they traded at pennies on the dollar with virtually no liquidity. Investors who still held shares were left with essentially worthless pieces of paper. The total investor losses were staggering. By some estimates, shareholders collectively lost over $10 billion in market value from the stock's peak to its collapse. Pension funds, mutual funds, hedge funds, and individual investors all took massive hits. Some institutional investors had bet hundreds of millions of dollars on Luckin, convinced by the growth story and the seemingly solid fundamentals. Those bets were now complete losses, and portfolio managers had to explain to their clients how they had gotten so badly fooled. It was not a fun conversation. But the damage extended beyond just the financial losses. The Luckin scandal triggered a broader crisis of confidence in Chinese companies listed on American exchanges. investors started scrutinizing other Chinese tech stocks more carefully, looking for similar red flags. Short sellers became more aggressive in targeting Chinese companies they suspected of accounting irregularities. And American politicians, already skeptical of China, used the Luckin case as ammunition to push for stricter auditing requirements for foreign companies. The entire relationship between Chinese companies and U.S. capital markets became more fraught and complicated. One of the most controversial aspects of the fallout was the role of the auditors. Ernst & Young, one of the most respected names in accounting, had signed off on Luckin's financial statements for years. They had supposedly conducted thorough audits, testing internal controls and verifying reported figures. Yet they completely missed a fraud involving hundreds of millions of fabricated dollars. How is that possible? The answer likely involves some combination of insufficient testing, over-reliance on management representations, and possibly even some willful blindness. EY eventually settled with investors for a significant sum, essentially admitting that their audit work had been deficient. As the investigations progressed, more details emerged about just how widespread the fraud had been. It was not just sales that were fabricated. Expense reports were falsified. Inventory records were manipulated, and internal controls were deliberately bypassed. The company had essentially been running two sets of books, one showing the fake numbers for external consumption, and another tracking what was actually happening. This level of deception requires planning, coordination, and a complete disregard for ethical and legal obligations. It was not a mistake or an accounting disagreement. It was deliberate, criminal fraud. By mid-2020, Luckin filed for bankruptcy protection in the United States, citing over $100 million in debt and limited liquidity. The company that had once been valued at $12 billion was now essentially insolvent, unable to pay its creditors or continue operations at the scale it had achieved during the fraud. Some stores remained open in China, operating under new management and trying to salvage what was left of the brand. But the glory days were over. The coffee chain that was supposed to challenge Starbucks had instead become one of the biggest corporate frauds in modern history. The human cost was significant too. Thousands of employees who had nothing to do with the fraud lost their jobs as Luckin scaled back operations. Many of these were baristas, delivery drivers, and store managers who were just trying to make a living and had no idea they were working for a company built on lies. Their careers were disrupted. Their resumes were now tainted by association with fraud, and they faced an uncertain future in a job market already stressed by the global pandemic that was unfolding at the same time. Regulators around the world started using Luckin as a case study for why stronger oversight of foreign companies was needed. The U.S. Congress began debating legislation that would require Chinese companies to allow American auditors to inspect their books or face delisting. This was a huge deal because it potentially affected hundreds of Chinese companies worth trillions of dollars. The Luckin scandal, in other words, had geopolitical implications that extended far beyond one fraudulent coffee chain. It became a flashpoint in the broader economic and regulatory tensions between the United States and China. As 2020 progressed, the criminal cases moved forward. In December, the SEC announced settlements with Luckin and several executives, resulting in $180 million in penalties. The company itself was fined, though given its bankruptcy status, collecting that money was questionable. More importantly, individual executives faced charges that could result in prison time and permanent bans from serving as officers or directors of public companies. The message was clear. If you commit fraud in U.S. capital markets, there will be consequences, even if you are based halfway around the world. The collapse of Luckin Coffee was complete and total, from hypergrowth darling to delisted fraud in less than a year. From $12 billion valuation to bankruptcy and criminal charges. From Nasdaq opening bell ceremony to congressional hearings about Chinese corporate governance. It was a spectacular fall from grace that destroyed billions in shareholder value, ruined careers, damaged reputations, and served as a brutal reminder that in investing, If something looks too good to be true, it probably is. And for everyone involved, from the executives who orchestrated the fraud to the investors who believed the story, the lesson was painful and expensive. So here we are at the end of this wild story, and you are probably asking yourself, what can I actually learn from the Luckin Coffee disaster? Because let me be honest with you, the point of going through all this is not just to entertain you with tales of corporate fraud, although I admit it is pretty entertaining. The real value is in extracting lessons that you can apply to your own investing decisions, whether you are putting money in individual stocks, ETFs, or just trying to understand how markets work. So let me walk you through the key takeaways that every investor should burn into their brain. First, and most obvious, if the growth story seems too perfect, it probably is. Luckin was supposedly opening thousands of stores while improving unit economics, acquiring millions of customers at low cost, and disrupting an entrenched competitor all at the same time. That is a lot of things going right simultaneously. And in the real world, business is messy. There are always trade-offs, always challenges, always something that does not go according to plan. When a company presents a narrative where everything is clicking perfectly quarter after quarter, your skepticism radar should start beeping. Real businesses have bumps in the road. They face competition. They deal with operational challenges. Perfect execution over extended periods is rare. And when you see it, you should at least ask yourself whether the numbers might be too good to be true. The second lesson is about the importance of doing your own homework, even when smart people are telling you something is a great investment. Luckin had backing from prestigious venture capital firms, coverage from Wall Street analysts, audits from Ernst & Young, and listings on the Nasdaq. All of those things are supposed to provide credibility and signal that a company has been vetted. But as we saw, all of that institutional validation was not enough to prevent or detect a massive fraud. The takeaway here is not that you should ignore expert opinions, but that you should never outsource your critical thinking entirely. If you are going to invest in a company, you need to understand the business yourself and be comfortable with your own analysis, not just rely on what someone else says. Channel checks are your friend, and this is something that even small investors can do to some extent. Remember how the short sellers hired people to sit outside Luckin stores and count customers. You do not need to organize a massive surveillance operation, but you can visit stores, talk to employees, check online reviews, and look for signals about whether the reported business activity matches reality. If a restaurant chain claims to be packed every night, but the parking lot is always empty when you drive by, that is useful information. If a retail company reports surging e-commerce sales, but their website looks outdated and clunky, that tells you something. The physical world often reveals truths that financial statements try to hide. Pay attention to related party transactions and complicated corporate structures. When you see a company doing a lot of business with entities controlled by insiders, that should raise a red flag. Not every related party transaction is fraudulent, but they create opportunities for abuse, and they deserve extra scrutiny. Similarly, if a company has a convoluted structure with subsidiaries in multiple jurisdictions and opaque ownership, that makes it harder to follow the money and easier to hide problems. As a general rule, simpler is better when it comes to corporate structure, and transparency is a sign of a healthy company culture. The role of auditors is important but limited, and you need to understand what an audit actually does and does not do. An audit is not a guarantee that the financial statements are correct. It is an opinion that they are fairly stated based on the testing the auditors performed. Auditors rely heavily on management representations. They sample transactions rather than checking everyone, and they are not trained to detect sophisticated fraud, especially in foreign jurisdictions where auditors may face language barriers, cultural differences, and limited access to certain records. The effectiveness of audits can be compromised. This does not mean audited financials are worthless, but it does mean you should not treat them as gospel truth. Cash flow is harder to fake than revenue, So always look at the cash flow statement alongside the income statement. Luckin was reporting strong revenue growth, but if you had dug into their cash flows, you would have seen warning signs. When a company reports big sales but is not generating corresponding cash from operations, that is a signal that something might be off. Cash does not lie the way accounting entries can. If the reported profits are real, they should eventually turn into actual cash that the company can use to pay bills, invest in growth, or return to shareholders. If that conversion is not happening, you need to ask why. Be especially careful with companies in emerging markets, not because there is anything inherently wrong with them, but because the regulatory and legal infrastructure may be weaker. In the United States and Europe, securities laws are relatively robust, and enforcement is fairly strong. In some other jurisdictions, the rules may be less clear, enforcement may be inconsistent, and minority shareholders may have fewer protections. That does not mean you should never invest in emerging market companies, but it does mean you need to demand a higher margin of safety and be more diligent in your research. The potential rewards can be higher, but so are the risks. Understand the incentives of everyone involved in the investment process. Company management has incentives to present the rosiest possible picture because their compensation and reputation depend on the stock price. Investment banks have incentives to be optimistic because they earn fees from underwriting and advisory work. Sell-side analysts often have incentives to issue positive ratings because their firms want to maintain good relationships with corporate clients. Even auditors who are supposed to be independent face conflicts because they are paid by the companies they audit. None of this means these people are dishonest, but it does mean their incentives may not align perfectly with yours as an investor. Keep that in mind when evaluating their recommendations. Short sellers, despite their sometimes controversial reputation, play an important role in markets by highlighting potential problems. The Luckin fraud was exposed in large part because short sellers did the hard work of investigating the company when everyone else was celebrating its success. Now, short sellers obviously have their own incentives. They profit when stocks fall, so you should not blindly trust them either. But when a credible short seller publishes a detailed report with evidence of wrongdoing, it is worth reading and considering their arguments. The best investors are willing to hear both the bull and bear cases and evaluate the evidence objectively. Diversification remains one of the most important risk management tools available to individual investors. Even if you do everything right in your research, sometimes frauds slip through or unforeseen problems emerge. If you had put all your money into Luckin, you would have been wiped out. But if Luckin was one position in a diversified portfolio, the damage would have been contained. This is why financial advisors constantly preach diversification, not because it maximizes returns, but because it prevents any single disaster from destroying your financial future. It is boring advice, but it works. There is also a broader lesson here about the limitations of hype and momentum investing. Luckin was the hot stock everyone wanted to own because it had momentum. It had a compelling narrative, and it seemed like you would miss out if you did not jump on board. That fear of missing out, or FOMO as people call it, drives a lot of bad investment decisions. When you invest based on hype rather than fundamental analysis, you are essentially gambling that you can sell to a greater fool before the music stops. Sometimes that works, but when it does not, the results can be devastating. A better approach is to focus on businesses you understand, valuations that make sense, and time horizons that are long enough to ride out short-term volatility. Now, a quick disclaimer, because I do not want anyone misunderstanding this. None of what I have said here constitutes investment advice. I am not telling you what stocks to buy or sell. Investing involves risk, including the potential loss of principal, and past performance does not guarantee future results. The Luckin case is a cautionary tale, but every investment situation is different. You should do your own research, understand your risk tolerance, and consider consulting with a qualified financial advisor before making investment decisions. Got it? Good. So what happened to Luckin after the collapse? Interestingly, the company did not completely disappear. After bankruptcy and restructuring, new management took over and tried to rebuild the business, focusing on the stores that were actually profitable. They scaled back the aggressive expansion, cut the excessive promotions, and tried to create a sustainable operation. As of 2023, Luckin was actually still operating in China with thousands of stores, and had even managed to turn a profit under the new leadership. It is a smaller, more modest business than the fraud-inflated version, but it exists. The brand was too damaged to ever list on a major exchange again, but the core product, decent coffee at reasonable prices delivered through an app, still had some value. The broader impact on Chinese companies and US-China financial relations continues to unfold. The Holding Foreign Companies Accountable Act, which was partly motivated by cases like Luckin, requires foreign companies to allow US regulators to inspect their audit work or face delisting. This has forced Chinese companies to make difficult choices about whether to stay listed in the US or delist and list elsewhere. It has also led to negotiations between US and Chinese regulators about audit access, a complicated diplomatic and regulatory issue that affects hundreds of billions of dollars in market value. So there you have it, the complete story of Luckin Coffee, from hyper-growth darling to exposed fraud to cautionary tale. $300 million in fake sales, billions in investor losses, careers destroyed, regulations changed, and a whole lot of very expensive lessons learned. The question now is whether you will remember these lessons the next time a company with an incredible growth story comes along promising to revolutionize an industry. Because trust me, there will be a next time. There is always another Luckin waiting to happen. Another fraud that seems obvious in hindsight but fools smart people in the moment. The key is developing the skepticism, the analytical skills, and the discipline to spot the red flags before you become the next victim. What do you think? Have you ever invested in a company that turned out to be too good to be true? Drop your thoughts in the comments below. And hey, if you found this deep dive into corporate fraud useful, you might want to check out more content on how to analyze companies and avoid investment disasters. Stay skeptical, stay curious, and never stop asking questions. That is how you survive in the wild world of investing.